For more on this story, let's turn to someone who is taking a close look at this and has been on the inside of the SEC in many of these cases. Mark Fickes, former senior trial counsel at the SEC and a partner at BraunHagey. BraunHagey, thanks for coming all the way from the other side of the bridge.
Thanks for having me.
Through the fog today.
We're in San Francisco now, so
exactly, all the better. First of all, I was really impressed. I've read a lot of these letters. You've probably written some of these letters. I was impressed by the work of the SEC accountants. Did you sense a tone here in these letters?
Well, the letters actually are fairly typical of the comment letter process. In other words, when a company goes public and files its registration statement with the Commission, there is a back and forth with the Division of Corporation Finance, and the back and forth that you see here is typical of any company hoping to go public. I think what's interesting is the number of requests for information that were repetitive. For example, you mentioned the stock sales issue. That was something that came up in several different letters where the SEC was asking the company to explain why that wasn't compensation to certain company insiders.
Well, I want to talk about the nuts and bolts, but I also wanted to go back to the tone a little bit. So if I can paraphrase what I think you just said, is that some back and forth is typical, but the resistance of the company to answer the questions and the insistence by the SEC to get an answer was atypical.
I think that is a little out of the ordinary. At the end of the day, if the SEC doesn't sign off on the registration statement and prospectus, you can't go public. So they do get to insist. Having said that, the back and forth seems rather extensive, and again, you get the sense that the company was being very resistant to answering certain questions and explaining certain
there was language from the SEC in some of the letters saying, we continue to believe that this is material. So let's talk about the issue you just brought up about the stock sales to insiders. In April 2010, investors pay about $3 per share to buy shares. The same month, the company buys shares from insiders at $5 a share, giving them a 68% gain in the share price over the course of a couple of days.
Right. Well, what's interesting about that is the SEC asked the company to explain why that shouldn't be treated as compensation for the insiders who were able to sell shares back. And the company went through some explanations as to why it wasn't perceived as compensation. There was some back and forth, but ultimately the company did treat that buyback as compensation, and as a result, there'd be a non-cash compensation expense on the company's financials.
Because I was going through the financials with every filing, and there was a lot of talk about the consolidated operating income, or the adjusted consolidated operating income, and there was talk about a lot of the letter from CEO Andrew Mason. But I couldn't figure out why the costs of the business in trailing months were changing with every filing, and it seemed like such minutiae. I didn't talk about it on the air here, but now we understand that they were engaged behind the scenes in this battle with the SEC as to whether or not they were paying even more to the executives of the company.
Certainly that's part of it, and if you look at the letters in the back and forth, obviously the SEC had a lot of different questions about, for example, the cost.
Let's talk about this.
Yeah, they were interested in in lots of questions about revenue. There were questions about revenue recognition policy. There were questions about some of the accounting metrics that the company originally wanted to use. And you'll remember a couple of months ago they had to amend the registration statement significantly because the SEC wouldn't sign off on the accounting metrics. They were very interested in the cost of acquiring subscribers, and also there were a lot of questions the SEC raised about what is a subscriber.
The whole thing, there was this, you and I talked about on the phone earlier today, but they looked at the website and said, hey, if you go to the website to learn anything, you have to give your email address. And once you do that, you're counted as a subscriber. So if you're going to put investor information on the site, are all of the potential investors also considered as subscribers?
Yeah, that was fascinating. I sort of had this vision of someone in Washington, an accountant, deciding to go to the Groupon website to see how it worked. And they discovered that you almost instantaneously have to provide information on your location and provide an email address, and then you're tagged as a subscriber. And in fact, the company explained that you have to click on a logo in the middle of the page to be able to view deals and not be deemed a subscriber. The SEC didn't say why it was interested in this, but one would suspect that a company might want to advertise publicly the number of subscribers it has.
Now, CEO Andrew Mason got a lot of attention throughout this deal, and some of it for the letter, the sort of non-standard letter to investors that he put in the first filing, right up front center, the very first thing you read in the filing, and the SEC seemed to have a problem with that.
Yeah, the SEC repeatedly was asking the company to balance its sort of balance its statements. There was a lot of talk about how customers were the only thing that the folks at Groupon care about, and the SEC came back and reminded the company that it actually has a fiduciary obligation to its shareholders,
right,
and that it needed to balance that portrayal in order to reflect the responsibility and seriousness with which it takes its responsibility to its shareholders.
I thought it was telling that the comments from the CEO had to be moved to a risk factor.
Yeah, exactly. I thought that was interesting. But as you know, the CEO has been controversial. There were issues with emails that were leaked, and so I think clearly the SEC was concerned about the whole mix of information that was going to come out to the public.
So here's the $10 billion question in this case. Why, with all these questions about the accounting, with all they clearly could see insiders were selling shares at favored prices. They could see that the accounting metrics were designed to look gussied up, to look better than maybe they might have looked if they're put in their raw and correct form. They could continually change these things. Why did the SEC let this deal get out?
Well, I think ultimately, there's a strong preference for the formation of capital in the marketplace. Congress is very interested in that. It drives the economy. And the SEC is there to safeguard the investing public, really not to stop the formation of capital or business development. So I think their role here is to sort of police the industry, go through this comment process, and once the company comply sufficiently with the SEC's concerns in terms of how the information has been made public, the SEC lets the company go to the market, and it's ultimately up to shareholders or perhaps someday the Division of Enforcement to take a look at whether or not the company is disclosing its finances honestly.
So, I mean, is there a philosophical difficult, or maybe a philosophy or two philosophies within the SEC or within securities law, even about whether or not buyer beware is sufficient enough?
Well, there's a tension. I mean, I come from the enforcement side of the SEC, and obviously what we're always looking at is whether the information disclosed is accurate. And if there are material inaccuracies, in other words, inaccuracies that investors care about, then the enforcement division is going to step in and take a look at it. So the SEC, I think, philosophically is all about disclosure, but ultimately those disclosures have to be accurate. And the flip side is, while they want capital to be formed out there, they do want to protect the investing public.
All right. Mark Fickes, we're lucky to have the insight from the SEC because you just got out. We're glad to have you out on the other side.
Thanks for having me.
Thanks a lot. John?